Veteran investor Jeremy Grantham, and our favourite bubble historian, that's what he's calling himself these days, was on another interview recently, and they asked him whether he thought we were still in a bubble, and he said, yes, we're still in a bubble, it's still to play out, and he explained himself over 2 hours, but I'm going to summarise it here, what he said. Hi everyone, JJ here with The Art of Value. Welcome, let's get straight into it. Just days ago, Grantham was on the Compound and Friends podcast, and they reminded him that he has said in the past that bubble historians sometimes are too eager to see bubbles, and they asked him if that was the case now. Is he being too eager to see a bubble in the market right now, in the economy right now? He said no, and he said everybody else is guilty of the usual crime of expecting a soft landing when it never comes. He added that the US Fed in particular has never called one of these bubbles correctly. They've never got it right. And he's talking back since Greenspan, multiple Feds, multiple administrations, they've never called it right. In fact, they've often called something different and being totally surprised by it when it happened. Now, in this interview with Michael Batnick and downtown Josh Brown, they grilled him a little bit about the bubble. They said he had a reputation as a permabear over time. And he said he sees himself more as a bubble historian. When he hears permabear, he said he'd like to shoot someone. He doesn't like that, but he's fine with bubble historian, studying the great bubbles over history. That's how he's decided that we are in a big bubble now. He's seen it. It's been going on for a while. He's been calling it for a while. I've made previous videos about him calling it month to month, year to year. And since 2020, that was the big blow off. And he says that it is declining now, but we're still in it. Now, to help shatter the myth that he is a permabear, they did acknowledge that he came out in March 2009 at the low of the market after the financial crisis, on the very day of the market low. In fact, he wrote an article, published an article called Reinvesting When Terrified, encouraging investors, institutional investors, to get back in the market, even though he knew that they were paralyzed. Everybody was paralyzed, very pessimistic time, the most pessimistic, in fact, because it was the low, but nobody knew that at the time. And he was encouraging people to invest and invest as much as possible, even if it was a half-baked idea. Get in there and start reinvesting. So he's not always a permabear. At the very low of that market, he was correct. Now they asked him again, are we in a major bubble? How are we in a bubble? And he said, yeah, of course, if you look at the 10-year smooth average PE and the Shiller PE, you find that there's a pretty decent spike in 1929, a much higher spike than that in 2000, and a slightly lower spike than that now. And on the screen, we can see that. We can see those three big spikes in the Shiller PE over time, and one was huge, the biggest one being in 2000. He says now, or recently, this is approximately the second highest point. And in each case, they fall back and go back to more average levels, even if you allow for a moderate increase in the norm. And he says people underestimate the time that it takes for these things to work through. We can see those massive spikes there back in 1929. It got to around 30, which is where it is now. Today, as I talk, it's actually 29.38. And of course, you see that massive spike in 2000, which was the highest in history. He says that's one of the biggest bubbles that's ever been, but that 2000 bubble was close to 45, and we're about 30 at the moment. Still 30, even after that bear market last year during 2022. It did come down a little bit from there, but as we see, it's still high historically. This is where he mentions the global real estate bubble that he sees as part of the super bubble that he's been talking about. He says it's driven up real estate prices all over the world in many places to multiples of family income. So it's definitely a bubble in many different places. He said in China and Beijing and Shanghai, the real estate prices got to 15, 20 times family income. He mentioned Australia as well, places like Sydney and Melbourne, and in Canada, Toronto and Vancouver, and also the UK, London. All of these places have had bubbles, massive bubbles with multiples of family income where people are unable to afford houses anymore. He added that mortgages have gone from about 3%, which he says explains everything, to about 7% recently. And he says that will start to explain a bit as well, presuming that he's saying that that will help real estate prices come down and pop the bubble over time. He said that real estate prices will start to come down in many places, including Australia, the UK, and the US. And of course, they are starting to come down in some places. In China, they're definitely having problems with the real estate market there. And where I am in New Zealand, in Auckland, real estate prices in many suburbs have come down 25% or so. So a steep decline, and we have had a huge bubble here. I've thought it's been a bubble since about 2016, and it just kept on going. Even during the pandemic, it kept going. But now we've had the sudden release, the sudden decline, and it seems to not be stopping yet. Maybe we and China are the canary in the coal mine there as far as global real estate prices go. We'll have to see. So they asked him how much he thought that real estate prices would come down. I think they were referring to the US, 10, 20, 30%. And he said he thought that 30% would be a pretty good guess. Now, he said what he's doing in the market is shorting the Russell 2000. He also said he's about 75% early venture capital, and his area of particular interest there is climate tech, and 25% hedging as best he can, he said. Now, if you're getting value out of this episode so far, please don't forget to hit that like button to help the algorithm out, to spread it to more people, help with visibility. Thanks. Now, this is his foundation. It's not in the firm GMO, which he hasn't got a lot to do with these days, or he's not running a fund there. So this is in his foundation and his personal funds, 75% early stage and 25% hedging. But Russell 2000 shorting it pretty heavily, he said. He also said credit default swaps in case this thing gets really nasty. Now, it's definitely noteworthy that he's shorting the Russell 2000, and he said that over 1, 2, and even 5 years, it's down adjusting for inflation. He says nobody adjusts for inflation, and the indexes, even the S&P 500 is down if you adjust for inflation. He said that the S&P 500 is 15 off its peak, at least maybe 16 or 17 adjusting for inflation. He said we've had reasonable inflation in the past 20 months since the S&P 500 peaked, so they can say, oh, it's only down 5 or 6%, but that's BS. In real dollar terms, it's down more than that. Now let's have a look at the Russell 2000, as that seems to be the main thing he's shorting at the moment. And over the past month, of course, it's down 5.75%. And over the past year, it's only up 5.96%. And over the past 5 years, it's actually less than that. It's up 3.83%. And as we can see, since early 2021, when he said that the bubbles first started to burst with stocks like ARK, the emerging tech started to crack, it's down 25%, over 25% since early 2021. And then since late 2021, when the major indices started to crack as well, the S&P 500, the Russell 2000 is down over 27% since then. So he's correct in saying that it has been going down, but he says it's down more than that in real dollar terms as well. So it's definitely significant that it's still down around 28% from that peak in late 2021. And as we can see on this S&P 500 chart, since about that same time, since the end of 2021, the S&P 500 is down about 10%. He obviously thinks these indices are going to continue down over an extended period, and the bubble is not finished unwinding. He has mentioned before that the AI boom that we've seen this year that's encouraged the market up is just temporary. It's just to put a pause on this larger bubble, and it will continue down. He said that as bubbles unwind, there are often big rallies, relief rallies, head fake rallies, and then it will continue down after that. That definitely happened in the 2000 bubble, the dot-com bubble, as it unwound. There were rallies along the way, but it continued down for 2.5 years or more, and he's thinking that it will continue down from here. He says a lot of things are in a bubble. He mentioned the fine art market has been booming for years in a bubble. He mentioned that one thing that's been left behind is non-US equities. He doesn't know why that is, but he says there's opportunity there outside the US. He doesn't know why that's happened, but definitely some value outside the US and equities outside the US, and that's where to look. He says not inside the US because it's so overpriced, but definitely some opportunity and value outside the US. Now, Michael and Josh asked him, could it be different this time though? Those 4 most dangerous words in investing, as John Templeton said, but sometimes it is different. Even John Templeton said that. Grantham said it's always different. It's always different in the ways it plays out, that history rhymes, it doesn't repeat. Grantham said that he actually argued back in 2016. He had a debate about whether it was a bubble or not back then, and he said he wasn't seeing it back then. He wasn't seeing the craziness and the mania that you need to see in one of these major bubbles. But then he said it happened later on. In 2020, we saw all that with the SPAC boom. We saw meme stocks. We saw NFTs. We saw so much crazy activity encouraged by the stimulus, of course, during the pandemic. There was definitely a mania there, and I do agree with that. There was some absolutely crazy things. We can see the rocket emojis, stonks could only go up. There was some real craziness there. Hundreds and hundreds of SPACs and meme stocks that went to the moon. All sorts of reasons why it was justified, but there was definitely a mania going on there. I agree with Grantham on that. And he said that was the blow off on the top, and it's kind of been declining ever since, apart from this AI rally that's been happening. But that was the mania that characterizes major bubbles. He did say, however, he doesn't think that that's the biggest bubble in history. He thinks that's Japan, because they had that real estate bubble and a stock market bubble at the same time, and it was huge. He mentioned that Japan real estate got really crazy. In Tokyo, the real estate was worth 10 times what it was in Manhattan, and New York was expensive. It wasn't cheap at the time, but Tokyo was worth 10 times as much. It was a massive bubble. He said the mother and father of all bubbles, the real estate and stock market together, and of course it burst, and it's taken decades to get over that, just getting over it now. We see Warren Buffett investing in Japan, so obviously he sees things there. There are other great investors having a look at Japan now. So maybe Buffett sees some serious recovery there in Japan now over the coming decades. He's a long-term investor. He doesn't invest for the short term usually, unless he's made a mistake. So he can definitely see something in Japan there. In percentage terms, it's become some of Berkshire's biggest investments in Japan just in the last year or two. Now, Josh and Michael did mention to him as well that could it be different this time because of the major US megatech companies, how great they are as companies. They've just been phenomenal. Some of the best companies that have ever existed. We can say that they're monopolies. And the news came out just overnight here, my time, about Amazon, the antitrust case that's going to be leveled at it. And Grantham said this, that every time there's been a bubble, there has been this narrative happen that these companies are so good that nothing can happen to them, that the bubble is justified, the companies are so good. And he said that he has to acknowledge that the FANG stocks, the Magnificent Seven, as they're being called now, are incredibly great companies with great management. They've got really wide moats. If you look at Google, it's one of the best companies that ever existed. Some of the best business models, they are genuinely new. But he said they've been allowed to be monopolies. And one thing that could happen to them is the regulatory factor. We've seen this in China where there was a crackdown, but in the US it could happen differently. They could get broken up or something on the regulatory front, the antitrust cases that could bring them down, or they could get disrupted by technology. He talked about Apple's iPhone could get disrupted. We can't see how now, we can't see why, but it happens. Even big companies get disrupted along the way. If it takes 10 or 20 years, it's really hard to see how Apple will be, or Google, though AI is coming along, but they are in the forefront of that as well, so it's really difficult to see. He said they've had great management, some of the best companies that ever existed, but it could happen, and there's this narrative every time. He talks about the Nifty 50 bubble, which I've talked about in previous episodes, and Kodak was part of that, so he mentions how they can get disrupted and go away pretty quickly. We just can't see it coming at the time, but there were companies back then that were definitely in a bubble, and it was similar, that these companies were seen at the Nifty 50 that you could just put your money in and nothing could go wrong. They just were so good that they were such safe bets. But it's never the case. Capitalism is brutal and stuff can happen. So even these great companies have now these monopolies. Things could happen even if it's on the regulatory front. Now, the host pointed out that Grantham has said that over the next 7 years that there'll be negative real returns in the US for the market. So he's pretty pessimistic about that, pretty bearish. And they said what would have to happen for that not to be the case, for it to be different this time. And he said what it would take is for the world to not behave like it has in every other major bubble in history. So it would truly have to be different this time for that not to happen. That's his opinion on it. So he's not seeing a great return in the US, at least for the next 7 years, but some possibility outside the US. Now, if you're watching on YouTube, I'm going to put links up here to the previous 2 episodes I've made about Grantham. The past one was just 2 weeks ago about the recession that he sees coming, this bubble unwinding, and the recession that he still sees coming soon when a lot of people don't see it. And also the AI boom that's pausing the bubble for a while. So there's been a rally in AI that's happened. He said that's just put a pause on the bubble. It hasn't stopped it from happening. So go and see those if you haven't already. And as I said, I'll put them in the description as well. And thanks for watching or listening. And I'll see you in the next one.